Okay, good morning, everyone. Um, Thank you for joining, depending on where you're joining. Um, it's a pleasure to welcome you to this webinar, and our topic is Beyond IFRS 17 Compliance, Navigating the Future of Finance and Actuarial Function. My name is Michael Oladeji. I'm a senior manager in the Actuarial and Quantitative Solution Units in Deloitte. With the advent of IFRS 17, I've had some quite good fortune to work with fantastic actuaries, finance professionals in the Nigerian insurance market. You agree with me that with the implementation of IFRS 17, it's been a monumental tax with the significant impact in finance and actuarial function. Before I hand over to the moderator, I would just like to cover some housekeeping rules. So the first thing is that the webinar is currently streamed live on YouTube. Please feel free to share the link with your colleagues and friends. Also, this webinar is currently being recorded, and the recording will be posted on our website immediately after the webinar. And for all participants, kindly note that you are muted on joining. However, if you have any question or any comments while the presentation is ongoing, please feel free to use the Q&A features on your screen. We would attend to your questions. Before I hand over to you, I'll just introduce the moderator. So the moderator for this session is Uyi Zeko, who is a partner in our assurance business unit and also our financial service industry leader. So Uyi, over to you.
All right, thank you very much, Michael. Good morning, ladies and gentlemen. It is my pleasure to welcome every one of you to this very important webinar titled Beyond IFRS 17 Compliance, Navigating the Future of Finance and Actuarial Functions. We have an impressive representation of participants across Africa online. We have got a good number of insurance practitioners in Ghana in attendance. Incidentally, we are currently hosting an IFRS 17 boot camp for Ghanaian insurance practitioners in Sun City, and they are currently logged on to be part of this webinar. Also, we have registered participants from Kenya, South Africa, Sierra Leone, Zimbabwe, and Cameroon. So once again, you are all welcome. This webinar promises to be very insightful and exciting. As you know, in the last 2 years, IFRS 17 was arguably the most important program for insurance companies. The first year of reporting has now come to an end. So insurance companies must now focus on how they can move from the very tense IFRS 17 mode to business as usual in a very seamless and less disruptive manner. This is what this webinar is going to be focusing on. So without much ado, I would now like to call on Michael Daudu, our audit and assurance market leader for West Africa, to give the opening address. Hello, Michael.
Yeah, morning, Kui, and a very good morning to everyone today. Very exciting day. I must, first of all, on behalf of our executive leadership team here in Deloitte, Nigeria, and West Africa, thank all of you who are going to give us 90 minutes of your time this morning to listen to some very, very important and pertinent updates around IFRS 17. We appreciate the fact that you all are taking time out today to listen to very important insights on this very evolving issues that have, as we has mentioned in the past 2 years, has been very dominating in the insurance space. So I want to, on behalf of our team, welcome all of you and ask that we spend time with the cream of important facilitators we'll be having today, who will be sharing some industry perspective. There's a lot happening around, data optimization processes, a number of things which are, fast moving within this space. So I won't take too much time. I know we have an exciting session ahead. And I once again want to thank all of you for joining us today. And we look forward to having more and more of these sessions where we collaborate with the broader team across the continent. Uyi, over to you.
Thank you very much, Michael. I think we can now move to the next segment. So we're just going to have a quick poll before we invite the keynote speakers. And the question is, what has been your experience with IFRS 17? Just one word, in one word, just one word. Your experience with IFRS 17 in just one word. I think participants can actually go ahead and do that voting just for us to be able to harvest what has been your experience with just one word. Okay. Okay, so we're going to harvest that while we'll then move over to the keynote speech. So I'm going to invite the keynote speakers. Okay. All right. So to give us a bit of some deep dive into the theme of this program today, I have two speakers. The first is Francesco Nagari. Francesco is a Deloitte partner based in Hong Kong. He is Deloitte's global IFRS insurance leader and the financial services industry leader in Hong Kong. He is also Asia Pacific audit and assurance leader for the financial services industry. Francesco has 32 years experience in the insurance industry with deep knowledge of the key European and Asian insurance markets and has led several audit and advisory projects with multinational insurance companies in Hong Kong, London, and Milan. He is an expert on insurance financial reporting, risk management, and solvency capital regulations. As a leading insurance accounting expert, he has been a member of several advisory committees for regulators in Italy, the UK, European Union, and Hong Kong. He is one of the advisors to ISB and a member of their IFRS 17 Transition Resource Group until its closure in 2023. Please join me in welcoming Francesco Nagari. And to support Francesco in dissecting on the topic, we have Frank Barbarella. Frank is a partner from the Hong Kong office and Deloitte's Global Insurance Finance and Actuarial Transformation Leader. Frank has more than 24 years of experience in transformation projects in financial services, ranging from core business transformation to technology roadmap and transformation execution, shared service centers shaping and setting up, and process optimization. Frank has been participating and leading multiple programs on IFRS 17 since 2018. And please join me to welcome Frank as well. So over to you, Frank and Francesco.
Thank you very much, Will. And good morning, ladies and gentlemen. It is a pleasure to join you virtually from Hong Kong to address you on some important considerations on what will be the future of insurance reporting. After the implementation of IFRS 17, we at Deloitte believe that we are looking at a reporting framework that is very much delineated by the efforts that insurance companies have put into the execution of what clearly has been a historically unique effort to transform financial reporting to an extent that is unprecedented, not only for the insurance industry, but I would say for the entire planet. I don't think that any sector can say they have experienced a level of change in such a short period of time as the insurance sector experienced in the last few years. We have observed that in the market, while everyone in the insurance sector operating within jurisdictions, and we are looking at more than 100 jurisdictions around the world, which have endorsed or converged for accounting standards to be in line with the ISB issued IFRS 17 for insurance contracts, other activities have occurred. In particular, I want to call out two aspects. The first one is the evolution and modernization of how insurance regulators have been considering the level of required solvency capital that insurance companies must hold to run their business and to protect their customers, their policyholders. The second one is the continued evolution of alternative performance measurement bases, in particular those who are focused on a value-based profit reporting, for example, embedded value. All these factors have led us to conclude that there are four corners of insurance reporting that CFOs and chief actuaries are gradually becoming operators and leaders on in every insurance company. And this framework, hopefully today, will give you a logical context to make sense of your work and hopefully to inform your future business decisions on how to do it better. As you can see, I have chosen a particular point in the linkage across these four corners, which is the fact that the four corners in two pairs deliver two ways of observing a fundamental performance indicator. It's not a key performance, it's a fundamental performance indicator, the return on capital. And that has got two facets. What I call the externally focused facet, where the return comes from an IFRS-based profit dimension, and the capital comes from a regulated risk-based capital balance sheet. And then there is an internally focused facet due to the fact that sometimes this return of capital is not published to investors, but is certainly used to steer business everywhere in the world. And that is the profit emerging from value-based profit reporting basis and the economic capital or other internal capital measures. So that tells us that at the center of insurance business is always the focus of the entire executive team on delivering the highest return on capital possible. That means that this fundamental performance indicator can be analyzed in the two dimensions, the one that is externally focused, highly audited, and the one that is internally focused, maybe less audited than the other, but equally important from a business perspective and from an investor perspective. The idea here is that the four corners are also a representation of the data, systems, and processes that are producing them. And now that we have completed around the world this enormous undertaking of implementing systems, data, and processes for reporting IFRS 17, along with, in many cases, also new systems, new data, new processes for both regulated risk-based capital and refreshed, strengthened value-based profit reporting, we have now an architecture underpinning the four corners of insurance reporting. And the connectors across the four corners are there to represent the necessity for the business to consider how each of these dimensions can be connected to each other. And the connectors are there to represent two dimensions of the business. The first one is the logical dimension. The CFO and the chief actuary need to have a strong intellectual control on how to explain the reconciliation from one basis to another. And that works in all the directions of the four corners. This requires a significant investment in the intellectual appreciation of similarities and differences, and then the cascading of that knowledge to a broad group of talented colleagues within the organization to create a real foundational structure in terms of knowledge within the talent of an insurance company. The other dimension is the one that comes from the operations and the systems of the business. Every connector would represent the connectivity from a system perspective and from a data perspective. These four corners have a greater level of similarity than ever before. The International Capital Standard and similar reforms that have been emerging from the International Association of Insurance Supervisors, adopted gradually in more and more countries around the world, are making the regulated risk-based capital converge towards a similar basis. And the stated intention of the International Association of Insurance Supervisors is to maintain a strong alignment with IFRS. So on the left-hand side, we already have a very aligned return on capital. Equally, the focus of IFRS and regulated risk-based capital on market consistent or market aligned variables to measure the expected future profit of insurance contracts makes economic capital and other internal capital measures, along with value-based profit reporting basis, reconcilable out of a strong level of overlap from a logical perspective, as well as from a data perspective and from a reporting perspective. And so the possibility for investors to be addressed by executives going forward in a way that enables the executives to navigate seamlessly across the four corners in order to address the needs of the investors to understand the reasons for the performance of a particular business is now becoming a compelling opportunity for CFOs and chief actuaries to consider in their further development of the finance and actuarial function within the insurance business post IFRS 17 implementation. This is a framework that Deloitte is still refining. So I have decided to give you a preview of what is likely to be a published piece of Deloitte eminence, as we call it, a point of view, sometime in early 2025. And Frank Barbarella, my very good partner, also based in Hong Kong like me, and we are working together to come out with a compelling explanation of how we believe the new metrics can be a strong platform to make finance and actuarial functions in an insurance business to be a very strong partner to drive growth and optimization of the insurance business as a whole. Having said that, allow me to then hand over to my partner Frank to address further the operational aspects of what the post-implementation of IFRS 17 offers to finance and actuarial function leaders. Frank, over to you.
Thanks, Francesco. And good morning, everybody. Very, very honored to be with you this morning. So to further complement what Francesco mentioned on the business side and on the metrics that are now in the market, I would like to draw your attention to two major findings out of the transformation that we've seen on IFRS 17. Number one is what is happening with companies around the world to embed IFRS 17 into BAU operations. The first wave of implementation is nearly over, not over yet everywhere in the world, but the first wave is done. However, a lot of insurers are now looking at optimizing what has been delivered. And a lot of initiatives have been launched around fast close, around optimization of processes, around data quality, around improvement on the operating model. A lot of insurers had to make harsh decisions to get compliance over the line and are now taking the time to refine their operations to make this more sustainable. A number of insurers had to increase, just to give an example, had to increase their workforce by something around 10%, 15%. That was mandatory and needed for the needs of compliance. But obviously, this is not sustainable. And getting back to normal BAU and a reasonable cost to run finance operations requires some of the initiatives that I just listed there on this page. So that's on the embedding IFRS 17 operations, and we are seeing all over the world multiple initiatives around those different topics. And the second one is using those new metrics and using this new business framework to drive the business and to drive the relationship and the communication with external investors. And we're seeing more and more, this is still very early adoption, and we're seeing more and more questions around how do we use those new metrics to drive the business. Obviously, it is still very early days, and the way to steer the business, the way to decide which product line to launch, the way to decide on optimizing operations, allocation of capital, all those things are still very new, and that they are not leveraging 17 yet. But we see a trend where this will become, back to what Francesco mentioned, more and more embedded with the other metrics that insurers have been using so far, and more used to drive business forward. And the second thing is around investor relationship and reporting. We're seeing pretty much in a similar way compared to what happened with other regulatory transformations like Solvency II. It is at this stage still early days. Numbers are published. Investors are starting to ask questions. They are not forming necessarily an opinion, but on 17, and they are more looking at 17 as a new standard with comparison to the existing basis and asking questions around the framework. But we'll see more and more the business moving from comparing 17 with what they've known so far to then asking and using 17 to make investor decisions. So those are the two trends that we're seeing across the world, and those are very IFRS 17 specific. But interestingly, if we look at what insurers are doing across the world, there are many more things that are being done on finance to optimize operations, and actually to optimize operations and transform finance beyond 17. If we look at the following slide, there are probably 4 main items that are covering the broad spectrum of what insurers are doing across the world. There is a first stack, which is around finance transformation, driven by new technology, driven by cloud, driven by ERP transformation, data transformation. We've seen a lot of initiatives launched by global insurers. And when I say global insurers, I mean multinational insurers operating in 100+ countries that are launching transformation programs at the back of IFRS 17 to not just optimize 17 operations, but transform finance on this particular topic. Behind those transformations are usually an objective to optimize cost across basis, across reporting lines, to further optimize the working day timetable, to set up and enable shared services if they are not enabled already, and to further reduce IT costs and move to cloud. Those are the main key drivers that we're seeing there, with obviously a reporting angle that is equally important. The second pillar is around actuarial transformation, and this is a completely different topic. This is around thinking about leveraging new ways of working, modernizing the models, rationalizing the way models work across the businesses, across the different countries, but also with a technology angle around how do new softwares and new technology enable to get better results, faster results, more and with a better cost to serve. We've seen quite innovative actors on the market that are pushing new solutions with new infrastructure behind it that are clearly a game changer. There are no widespread adoptions yet, and those new niche players, but there is a wave of transformation going on. The third item is around FP&A transformation, and this is around planning, forecasting, it's around integrated reporting. And this is the wave of transformation is to connect this piece of processes and the people working in those organizations, to connect them more with the transformation that has been done on the other metrics, but also to leverage and to optimize their ability to serve the business. And they have also the same requirement to go faster, leverage new technology, connect with data, leverage cloud transformation initiatives. And they're all combined together, targeting the same objective to better serve the business and optimize costs. And the last one that is probably on the agenda of each CFO in the world is the disruption by new tech. Gen AI for finance, how is it going to help and how is it going to transform what the operations are looking like today? At the moment, there are only a handful of cases that are leveraging Gen AI in production, a handful of cases that are mostly around modeling and mostly around data analysis and reconciliation to prevent errors and to accelerate work in their timetable. But those are just the two very simple examples and are very early day in the transformation journey. We expect a lot around this space, as definitely technology is far from being ready to serve more complex use cases. But there is a trend where Gen AI will play a more and more important role in the way to serve finance and in the way to operate as a business. Those are the four main pillars, and we are consistently seeing all over the world large transformation projects that are launched on those different areas. Let me hand back over to our moderator.
All right. Thank you very much, Frank and Francesco. I'll just ask, our participants, if you have any question for Frank and Francesco, please feel free to just drop it in the Q&A. And I think this is an eye opener. I don't know if you caught it, Francesco, in terms of the model that Francesco showed. That's something that Deloitte is working on, and it's not yet in the market. So you are privileged to be the first to begin to see that new line of thinking around, the reconciliation between embedded value reporting and IFRS-based profits. Then on the other side, economic capital and regulatory capital. And I mean, one thing that struck me from what Francesco mentioned was, the amount of intellectual power that will be required, from actuaries and CFOs, to be able to connect all of these dots together so that you're able to create, the right value. And also just listening to Frank, I see that technology is going to play a very major role in terms of how the finance function within the insurance industry will transform, and likewise the actuarial function as well. So I don't know if there is any question. I'm just going to check now. I think there is a question here that says, is IFRS 17 designed for which companies physically? I mean, which size? Okay, I think that's okay. There's a question that says, kindly explain further on the relationship between embedded value and IFRS 17, or rather embedded value. Okay, embedded value and IFRS 17. Francesco, I guess that's for you.
Yeah, it is. Thank you very much for your question. Look, the explanation is this. Both embedded value and IFRS 17 starts the accounting of an insurance contractor from a common purpose, which is determining an economic view of the expected profit from a new contract sold today. When you look at the requirements, the building blocks of IFRS 17, you find that the first and the second building block are 50-50, so a statistical mean, no prudence. A 50-50 probability weighted present value of all future cash flows. And the outcome of that then is increased with the liability, specific liability to the company to provide for the uncertainty that the company risk appetite would actually provide for. So you have effectively, as a result of that, a day one profit. That is equivalent to the same that you do in embedded value. The embedded value accounting looks at an economic and anticipated expected profit on the point of sale of an insurance product. The difference, the fundamental difference, is that IFRS 17 is a business to customer model. Embedded value is a business to business model. What does it mean? It means that you earn money, profit, by serving the client, business to customer, in IFRS 17. And so the day one profit, the expected profit from the sale of an insurance contract, which is an equivalent dimension to the new business profit in embedded value, 17 says you cannot take it to your P&L immediately. You have to report it as a separate, explicit component of the portfolio called the contractual service margin, CSM, and then you earn it as you serve your customer. Embedded value instead takes a business-to-business perspective. So imagine I sold the policy. What would it be, the price I'm going to get if I sell it to another insurance company the day after, or the moment after I sold it to a customer? And so the idea then is if I expect the product that I sold to be a profitable one, then I report profit on day one. And so the timing, the economic timing, so the accounting timing of the same economic dimension, the expected profit, is the first and fundamental difference that needs to be reconciled. Insurers, in fact, have already worked out that this is actually the key reconciling item. And so you will see several insurance companies have already started to report alternative performance measurements. And the one that they've done already in the first year is this. They call out an adjusted equity measure. And they say, our real equity is not just IFRS equity as reported. It's IFRS equity plus the CSM, because the CSM is a store of value. And so it's just a timing, but this will become equity at one point in the future. So if you really want to know what is my financial strength, look at equity plus CSM. And then what they've done, they've compared that to embedded value. And so ensure the fact that there are other differences, and that's where I'm going to take you next. So if the economic profit is effectively the CSM and embedded value reports it immediately while IFRS reports it later, from a balance sheet perspective, when you are comparing them, you should have no difference. But there are some. What are those differences? Two differences in particular. The first one is what I would call scope differences. So within that macro category, you have a couple of things. The first one is embedded value looks at the business as a whole. IFRS 17 only looks at insurance contracts in the business. If you're selling savings plans that are not transferring any insurance risk, but you have them on the balance sheet of an insurance company, embedded value will measure them on an embedded value basis. In IFRS, you don't. You have to follow another standard, which is IFRS 9, which is more conservative in terms of reporting the expected profit. In fact, it's not reported. You got to wait and see that you're serving is still a business to customer model. So that one can create an extra embedded value profit on day one, which you don't see in the CSM or in another accounting dimension in IFRS reporting numbers. The other difference, I would call it the bucket of measurement differences, and you have them effectively in two major categories. The first one is how you look at financial variables and market observable variables. A number of embedded values, which is which are in circulation, they are not market consistent. IFRS is market consistent. And so that can create a tiny difference in terms of how you measure the volatility. So actuaries, be careful in terms of what embedded value approach you choose for your company, whether it's market consistent or not. That could create a difference on the IFRS. The other one is a fundamental concept in IFRS called the contract boundary. It does not exist in any embedded value basis. So you may end up capturing a more extensive volume of future renewal premiums or charges from an embedded value basis than you would in an IFRS 17. So these are other reasons which would normally make IFRS 17, even adjusted with the CSM being counted as profit, still a little bit more conservative or less optimistic than embedded value is.
All right, thanks, Francesco. I think there's a similar question. I guess you might have covered it, to some extent when you were answering the first question from Folusho Sowande. He's asking, can you speak about the new KPI measure in IFRS 17 and how it relates to embedded value under IFRS 17?
Yeah, I can actually expand a little bit more on this one because in addition to the, I would say, GAAP KPI, so IFRS 17 profit, and normally looking at these in three forms. The first form is what IFRS 17 effectively mandates now. It's called the insurance service result. If you want to call it in another way, a form of underwriting profit. Insurance revenue less insurance service expense. That's mandatory. And the beauty of being mandatory, it means is highly comparable. And so that's the one version of IFRS profit to keep in mind. The second one is also semi-mandatory in the sense that is the net finance results from insurance business, where you have the mandatory insurance finance income or expense, effectively the effect of financial variables from the movement over time of the in-force liabilities from insurance contracts and the return from the financial assets that the company holds to back those liabilities. The difference between those two numbers creates a net finance result that, combined with the insurance service results, will give you then an operating profit baseline. That could be fully reflecting volatility, or you can then use the OCI option to strip out volatility from market fluctuations and move into an operating profit configuration that gives you then a more stable, based on amortized cost considerations in the net financial result. You can see already I've given you 3 reference points for the return part of the return on capital. And then you got effectively a 4th one, which is the net profit before tax. Each of these 4 profit configurations can then be related to the equity and give you a return on equity, or to capital and give you a return on capital. These KPIs are now deemed to be back into the mainstream of financial analysis. I've spoken with several sell-side analysts around the world, and they all welcome IFRS 17 for one particular reason, which is they now can see consistency and transparency in how insurers are reporting, enabling fundamental analysis from a financial perspective in a way that has never been possible before, when with IFRS 4 everything was possible and therefore comparability did not exist. Another important KPI I want to mention is the fact that with the CSM as a storage of value on the balance sheet of insurance companies, analysts are becoming more and more interested in understanding how much of it comes out every year and goes into revenue and profit. So the runoff rate of the CSM has become already another very commonly commented key performance indicator. And you can see already that cross-section analysis across a peer group of companies are starting to emerge to see which CSM moves faster into profit, why not, and then how much of the new business CSM comes in. So a lot of KPIs around CSM movement, CSM unwinding, CSM unlocking, in terms of the unlocking for financial variables and the unlocking for non-financial variables. It's an enormous amount of opportunities and possibilities that are only available now because of the consistency and transparency that IFRS 17 delivers. So it's a bounty for sell-side analysts, and they are diving in deep and fast.
Thank you very much, Francesco. I think that's really very quite insightful. I think the last part of what you said around CSM runoff, unwinding, unlocking, I think that clearly it's one of the key areas that is, fast getting attention. And thank you so much for that very insightful presentation. We don't have time to take further questions at this stage, but please feel free to drop your questions in the Q&A box. And at this point, we're going to move to the other segment. And as we move to the other segment, I just want to say a big thank you again to Francesco and Frank for their time. They are global leaders as far as insurance is concerned, and it's really a privilege to have them with us. Thank you.
You're welcome, and I wish further success and learning from what looks like an incredibly powerful and informative event. Thank you for having us as your keynote speakers today.
Yeah, thank you. Thank you. All right. So now we move to the next segment. Now we're bringing it home, bringing it closer home. We have a power-packed panelists who are going to be, sharing their experiences and also dissecting, the world of IFRS 17, post IFRS 17, finance, and the actuarial space. And in no particular order, I'm going to start with Yemisi Rotimi. Yemisi is a qualified accountant with over 25 years experience as a senior finance executive, holding senior positions within world-class organizations like Royal Mail, Bank of Ireland, and Lehman Brothers. Her responsibilities covered all aspects of finance, from planning, budgeting to regulatory reporting, risk, financial control, treasury, tax, and procurement. Yemisi holds a master's degree from the University of Greenwich, UK, and is a fellow of the Institute of Chartered Accountants of Nigeria. She is also an associate of the Chartered Institute of Management Accountants and Chartered Global Management Accountants, CGMA. She is the CFO at Leadway Assurance, where she leads the finance transformation agenda. So let's welcome Yemisi Rotimi as one of our panelists. And second is Jane Mberia. Jane is the current group CFO at Continental Re, based in Lagos, Nigeria. Jane has over 20 years experience in reinsurance accounting, having solely worked in the reinsurance industry in finance department. She led the team in IFRS 17 implementation for Continental Re. She led the team in IFRS 17 implementation for Continental Re. Previously, she worked in Eastern African subsidiary based in Kenya. She has also worked with East African Reinsurance Company Limited and Housing Finance Company Limited in Kenya. Jane holds a Master's of Business Administration from the University of Nairobi and a Bachelor of Commerce degree from Kenyatta University in Kenya. She's a Certified Public Accountant of Kenya and a Registered Accountant with the Institute of Chartered Accountants of Nigeria and Chartered Insurance Institute in London. So let's welcome Jane. The next person is Kyo Wangasha. Kyo is a qualified actuary with over 8 years experience in actuarial consulting. She's currently the chief actuary at ICO Insurance, where she leads the actuarial division. Her current role involves overseeing IFRS 17 reporting, product development, capital management, and overall business strategy support. Prior to joining ICO, Kyo was a resident actuary with Zamara Actuaries, Administrators, and Consultants Limited. Kyo has extensive experience in actuarial consulting, having served a diverse portfolio of life and non-life insurance across East, Central, and West Africa. Q, you're welcome. And next is Oluwatoyin A. Charles. Oluwatoyin is an experienced fellow chartered accountant with over 25 years of notable experience and achievement in the insurance regulatory agency. She holds a bachelor's degree in accounting from Obafemi Awolowo University, Ile-Ife, and a master's in business administration from Ahmadu Bello University, Zaria. She is currently the Director of Supervision Directorate in NICOM, where she's responsible for overseeing the off-site supervision of all categories of insurance institutions, with emphasis on financial analysis, risk, and levy assessment. Prior to this, she has effectively led the internal audit department and finance and accounts department in NICOM. Let's welcome Mrs. Charles. The next is Amit Bana. Amit is a partner in Deloitte Financial Services Advisory Team and is the Deloitte Africa Insurance Finance and Reporting Lead. Amit works from the Johannesburg office in South Africa. Amit is currently representing Deloitte Africa on Deloitte Global IFRS 17 Technical Expert Advisory Panel. He is a core part of Deloitte team who have developed several IFRS 17 project accelerators and tools, including the IFRS 17 e-learning solution. Amit has assisted numerous clients with the implementation of IFRS 17 in both life and general insurance perspective, locally and internationally. Let's welcome Amit Bana. And last but not the least is Kehinde Olorundare. Kehinde has over 22 years hands-on experience in the insurance industry here in Nigeria. He began his career at IGI. Kehinde has functioned in several senior management roles in finance, including financial control and group head financial reporting, performance management, business intelligence at Leadway Assurance for 13 years. Prior to joining Hess General Insurance, Kehinde was the Chief Financial Officer of Cornerstone Insurance. Kehinde holds a bachelor's and master's degree in accounting from the University of Lagos, as well as a doctoral degree from Babcock University, Ileshan. He's a senior member of the Chartered Insurance Institute of Nigeria and a fellow of the Institute of Chartered Accountants of Nigeria. So let's welcome Kehinde. And Kehinde, on a lighter note, I actually didn't know you are a doctor. I think I have to start addressing you as a doctor. So Dr. Kehinde, you're welcome.
Yeah,
okay.
Thank you.
All right. So thank you very much. And to all our panelists, we are now going to move over to the question and answer sessions for the panelists. And in no particular order, I think I'm just going to start with a general question for everyone. So I would expect all of the panelists, I'll just call your name and you'll respond to that question. So the first question, which is really a general question for everyone, IFRS 17 implementation for insurance entity in Nigeria has been quite a journey. I'm sure everyone would agree with that. What were the challenges and key lessons learned so far? Challenges and key lessons as CFOs, as actuaries, and even as regulator. Let me start with Jane. Jane?
Thank you. Good morning, everyone, and good afternoon for some of our participants. Yes, IFRS 17 has been a journey, indeed, a 6-year journey since the initial implementation date. And one of the main challenge is data. I'm actually going to classify into 3 categories: the data side, the system side, and then the resources side. That's the people. Data, the volume of data that we saw, especially in the first year. Remember, we had the transition year, 2021, Then we had the restatement 2022, and then we had the 2023. We had big challenge there, especially for us at reinsurance level. Issues around groupings, aggregations, product classifications, onerosity testing for PA eligibility. That was quite a tall order. It took us a lot of time there. And the key lesson there we learned, I think, the importance of data warehouse and systems. Going forward, data is going to be very, very critical. The other one is the level of granularity. Some information was actually not readily available. So we had to make some high-level assumptions just for completion of that information for some of the disclosures that we needed and some of the testings that we had to do. The other one was the policy choices and the models. Initially, we actually wanted to adopt the full retrospective transition model. But because of the data challenges in some instances, we now had to actually go to the modified transition approach. So these were really, really challenging. Then we had issues around what policy choices to adopt, like discounting. We had issues of illiquidity premium and yield curve. Yes, regulatory guidelines came out. NICOM issued some illustrative financials and guidelines. They gave us some of the policy and modeling choices, such as discounting, risk adjustment, determination of what is materiality, which was a big challenge because materiality was quite a gray area, and this was quite cumbersome during the audit. So all these, I know also the Nigerian Actuarial Society came up with a yield curve, and even then, even the determination of illiquidity premium is still something under discussions. Then when we went to the systems and processes, initially, I think some of the work had to be manual. Systems were so expensive. A lot of them needed a lot of coding. So eventually we settled for the risk integrity by Moody's, which was quite customized and at that point easier to use. Then now we had to look for a way of integrating that with the actuarial systems, underwriting, and the accounting softwares that we have. And then the big one, which was resources and people as well. The costs were extremely high. We had all those years, 6 years, we had to do so much training, staff training across the group. And you can imagine we are based in different regions. So, and you need to carry everybody along. The initial systems were very, very expensive. But as time went by, we started seeing more options and more, in quote, affordable systems that came up. We had to get an implementation partner. Of course, it came at an additional cost. And then the audit itself. So it was an additional scope in the audit because we had to do a IFRS 17 audit, which was outside the financial audit that we normally do. And then the project management team, initially we were multitasking. We didn't realize that IFRS 17 was actually a very, very intensive project. So, and with this, we had to do rebudgeting, we had to do closer implementation, we had to do like a standalone implementation and have key people. And then we had to do a lot of capacity building and upskilling of our teams. And then the other challenge was now the stakeholders' understanding. We all know that IFRS 17 had new terminologies, new presentations, and we had to carry all the stakeholders, our shareholders, board members, tax teams. We had to carry them along, some of our investors, and just explain what is happening to our financials and what they mean. Thank you.
Thank you very much, Jade. I think you covered quite a whole lot. Thank you so much. And I guess everyone can, it resonates with everyone. Maybe I should call on Yemisi. Yemisi, can you just share your experience?
Thank you very much. Am I audible?
Yes. Excellent.
Great. Thank you very much. Jen pretty much covered everything, but I think there are two things that I think stood out for us as a business. Being a legacy business, Leadway's been in business for over 50 years. We have a very big long tail business. So for us, just to add to what Jane had said, data was a big issue. So it was an opportunity for us to overhaul our enterprise data systems. But also on the people side, change management was really an issue because as a business, the culture, the ways of working, collaborating with other departments was really important. So particularly when you look at the way IFRS 17 was implemented, the actuaries actually became, it was very actuarial heavy. So for us in finance, we had to make it our business to understand what was happening on the actuarial side, the models, the assumptions, the methodologies, have a lot of conversations around just to make sure that there's internal alignment on between what the actuaries are doing and the way we intend to report IFRS 17. I think the other point that just to add to what Jane has said was around also proactive engagement with the regulator and external stakeholders. You'll find that I think Nigeria was a bit behind the curve. This was a journey that started 6-7 years ago, but we probably didn't really get on top of it until about 3-4 years, before implementation date. So that early engagement that allows for proper planning and enough time to be able to test your systems. In our case, we actually implemented a new actuarial system. So we overhauled the actuarial system, overhauled our financial systems, overhauled our enterprise data system. So that's a massive operation. And just even bringing everything together was a great challenge for us as a business. But we're glad we're here. We survived it. Thank you.
Thanks, Yemisi. Maybe from the actual end, Q, can you share some thoughts? You're muted.
I realize that. Sorry. Thank you very much. Now, on the actuarial side, I want to say a lot of the challenges have been mentioned, but the biggest challenge really was the implementation of systems. Now, the implementation of systems in the context of the actuarial side had to do with a challenge in learning. Maybe we're not always very humble to just learn. So IFRS 17, the biggest challenge was learning the standard, and then learning the standard in the context of the system that you're using. So how the models are supposed to be built within the system. You would have to have a good understanding of the standard so that you can now interpret what is coming out of the system. I think that is the really biggest challenge and a learning point, that there's no shame in having to learn. Let's just embrace learning. We're still continuing to learn. Right. That's all I would say.
Yeah, thanks, Q. And maybe just taking the cue from there, Kende, Q has said something about learning, which for me, I think it's very spot on. Kende?
Yes, thank you very much, Uyi. Good morning to our audience and good afternoon to some of us that may be ahead of us in time. So a lot have been said already, and I will try not to repeat what they have already said. I think I will say that IFRS 17 is arguably the standard that have taken the longest period to implement in the history of standards that we have seen so far. A standard that was issued in 2017 and then was eventually implemented in 2023. That's a whole 6 years. Of course, implementation date was first fixed for January 2021. It was moved from there to January 2022 and then moved again to January 2023. And because of the movement, postponement twice, most of us didn't really start early. To be honest, some of us were thinking it's going to be postponed again, that it will not take effect in 2023. So we didn't start early and we didn't appreciate the enormity of what is required. I will tell you that IFRS 17 is a complex standard. That is the experience I will share with you. Quite complex. I think we underrate it. We didn't expect that it would be that complex. Most of us didn't have our hand on it practically until when we prepared the 2023 audited financial statement. That's when we have our hand on it practically. Of course, before 2023, we were attending training, and most of the things we're doing were theory. We're learning the theoretical part of it, but now we see it in real practical terms. And then I think we appreciate how IFRS 17 is a complete game changer. It's not business as usual. It's different from IFRS 4. And so another challenge that we also face, I don't want to repeat what people have said, there is scarcity of skill in the industry. To be honest with you, I think most of us have to depend on consultants for the first year implementation. And I recall how stretched the Big Four were, the likes of Deloitte and other Big Four firms, quite stretched because the entire industry have to rely on those four for consultancy services in helping to implement IFRS 17. So it was quite challenging and also expensive. Yes, it's quite expensive. Some of us are just trying to get our hands on it now. So if you ask me, what is the lesson that we have learned? Because you put your question as a two-in-one, the challenges, and then what are the lessons? So for me, the first lesson is that we must take the IFRS 17 training seriously. We must learn about it. We must continue to learn it. We must train and retrain. We must unlearn IFRS 4. I mean, take it out of our brains. IFRS 4 is gone and is gone. And we must take it as such and brace up to learn IFRS 17. Give it whatever it takes for us to learn it. I know there are challenges of the system and then, legacy processes that have been on for more than 20 years in some cases. But the truth is we have to unlearn those legacy knowledge and then bring in the IFRS 17. We must take conscious step. We must, consciously and intentionally build capacity and competency on IFRS 17. And then we must attract, people that can help, people that have skill. We must attract them and find way to retain them so that the challenges of IFRS 17 can be minimized. Thank you very much.
Yeah, thanks, Kendi. And maybe the last person to speak within the segment will be Mrs. Charles. From a regulator perspective, were there challenges from your end, and what would you say are the lessons learned?
Thank you very much. Good morning and good afternoon. Well, from our end, we observe, we are the regulator. We are the receiving end. We observe late submission of IFRS compliance financial statement from the insurance company. Despite the fact that we all understand that IFRS 17 is technical, that has always been the language being used all over. It's a technical standard. It's a technical standard. But we observe that some companies are still, we observe preparedness. They did not prepare on time. They assume that, maybe it's IFRS 17, we can always just leverage and quickly adapt. But not knowing that IFRS 17 entails a lot of issues. Is it about the system? Is it about the process? Is it about understanding the standard itself? Was a major issue. So when the time comes for them to do submissions, you discover that so many people did not submit. They were not coming forth. And we can't really blame them because they don't understand what it entails. So I believe, and there was a lack of comprehensive testing and dry run of their financials during the implementation strategies. Because they don't understand the transition, how do we migrate from IFRS 4 to 17? So many of them are still using terminology of IFRS 4, despite the fact that they're already embracing IFRS 17 terminology. So we observe again that there were a lot of reliance on third party Most companies rely on the actuary and the external auditors to prepare their financials for them. So it was a little bit difficult for the CFO to defend or to come and present or even defend the figures that they have in their financials. Because for us as Nikon, we provided a platform where they can do pre-submission presentation so that they're able to look at what we have done so far, how can we improve on it to shorten the timeline that we're going to use in streamlining and getting the financials submitted on time. But majority were not forthcoming because they don't have understanding. And we observe data gap. A lot of them have system limitation. We observe that there's insufficient subject matter experts. From what had been said earlier on, we discovered that most of them that prepare their accounts, they have to rely on the big four to come and add or even to help them in implementing the IFRS 17, in preparation of the IFRS 17. So that was really a major challenge. There was lack of insufficient, there was no subject matter expert on IFRS 17. They've engaged on a lot of trainings, but training is different. When it comes to hands-on practical implementation, adoption of the IFRS 17, you discover that they were not prepared on time. There was no preparation. The preparation was so poor. So that accounted for late submissions and more reliance on third parties. So many of them still rely on third party. And we observed that they incur a lot of huge implementation costs. That's from what we can observe from what happened. And there are challenges in terms of capacity. Having in-depth understanding of the IFRS 17, that's the challenge. And we also observe that the disclosure requirements, because they don't have full understanding of what it entails, they are still battling with disclosure requirements. There was difficulty in the presentation, moving from adoption from IFRS 4 to 17, and that took a whole lot of time for such to be corrected. But nevertheless, we are here. They've really overcome that monster. That's the way I can describe it. Because when you talk about the IFRS 17 in the insurance industry, we all look at it as a monster that cannot be conquered. But here we are today. We have adopted. Well, there are lessons learned from us from the regulatory perspective. We understand that there's need for us to have more continuous engagement with stakeholders, especially the CFOs, the CEOs, and then there's need for better collaboration between the actuarial function with the finance function, which is very, very important. And there's need to leverage on technology solutions. So many of them got solutions that they could not use because they were not mapped to their system and they were not mapped adequately. So they find it difficult to turn out their financials. So there's need for high quality data management is very, very important. We believe that going forward, things will get better and the financial reporting will become more easier and be able to achieve the aims of transparency and consistency that IFRS 17 has to deliver. Thank you.
Thank you very much, Mrs. Charles. I guess insurance companies would do a lot better this time around, having gone through the first phase. Amit, I will come to you, Amit, and maybe you can just also, I want you to take your response to that question alongside the next segment's question, which is, we talked about data being a key aspect of IFRS 17 journey. What is your advice and what should entities be focusing on from a data transformation point of view?
Sure, perfect. So I fully agree with everything that's been said to date. I think IFRS 17's brought a lot of greater alignment between the finance and actuarial teams, but it's definitely come at the cost of the working day timetable. And what we've seen is that as finance teams transition to business as usual, we're seeing that demand for full-time resources in both the finance and actuarial space. to support the extra demands of IFRS 17. So there definitely is now a greater focus around process optimization, refinement, and improvement. And that follows through into the data space as well, where, post IFRS 17, data considerations have to evolve from the preparation and setup of the data to more now ongoing efforts around refinement, optimization, and continuous improvement. We're seeing that there's still room for improvement in terms of data quality and especially granularity. So projects now need to focus on getting their data into a form that enables the finance function to provide meaningful insights to some of the internal business stakeholders. So this involves linking financial outcomes more closely with the operational data so that you're able to improve the decision-making process across the business units. So some of the key focus areas around this is data accuracy and continuous improvement. So that's where insurers should continuously refine their data extraction, the transformation of the data, and the reporting processes based on the lessons that have been learned during these reporting cycles that they've been involved in now. And secondly, as I mentioned, it's around the operational efficiency and automation. Now, post-implementation is the time, and this is where you have to maintain momentum to assess your manual processes that were initially used to meet the tight timelines and try and replace them with more automated workflows. So this ensures that the data processing is a lot faster, a lot more reliable. It also allows you to optimize and re-engineer your data workflows to ensure seamless integration between finance, actuarial, and data. Other areas of focus is probably the reporting cycle efficiency, the data integration, as well as system enhancements to ensure that you have good data governance and auditability. So for me, I think, in terms of ensuring that the finance process does keep improving, that ensures ensuring that the data process keeps improving as well. They are very much interlinked.
Yeah.
Thank you.
Yeah, thank you very much, Amit. And maybe just following from that point, I see there are already questions around KPIs and all that. Jane, back to you. How do we see KPI changing within the business? What do you think are the new metrics, that are important for stakeholders?
Okay. I think first and foremost, we start defining the new revenue account under IFRS 17. You notice it's slightly different, actually significantly different from what we had before. Revenue is a very key item in the revenue account. And the definition of revenue is totally different from what we knew before. And this, you have to separate your insurance contracts issued and your reinsurance contracts held. That is very important. So when you define your revenue, then you know it's purely from the insurance side and it's comparable across. And this also forms a key denominator in many ratios. So as much as it may sound the same, like loss ratio remains, combined ratio remains, expense ratio remains, as much as terminologies are same, but if you look at the formula or the calculation, there's quite a bit of difference and you have to be careful about that. So when you're working out your loss ratios, you know what the denominator is. It's the revenue, and now we know what the revenue is. It's for the insurance contracts issued. Then what else has come out is the separation of your insurance business and your reinsurance business, so that you don't mix them up, and reinsurance contracts held are now an independent cost line item. That also is really has to be separated. The other one I have seen is a very key one, especially on your LIC, loss for insurance for incurred claims. You will notice that there is now an introduction of prior year business, which is past service and current service. So this alone, you can derive key ratios, and depending on the user, if you really want to look at the adequacy of reserves, these are very key KPI, because you'll be able to look at your past service and you can see it in the disclosure, which tells you whether that company actually has been maintaining adequate reserves or not. So lately I've seen a lot of what we call AVE, actual versus expected, which really goes to define your past service and also your current service. And then we spoke about the CSM. You also need to look at how it is unwinding. Same thing, you also need to look at your loss component. And that helps you define which portfolios or which contracts, depending on how you did your groupings, is making losses. And what comes in there is also another key ratio, which is around your expenses cash flows. So all these models are very critical because they go in and have an input on your cash outflows that affect the performance of your contract. So you also need to pay attention to your onerosity ratios, and you can also have it as a numerator, and you can use various denominators just to define it. The other key one I'm seeing is the interplay between your discounting, your risk adjustment, and what assumptions you're using and the movements. Depending on the market you're operating, this is a wake-up call, because then now you'll be looking at how you are allocating your assets, because this determines how you come up with your yield curve for your discounting purposes. You may also want to look at some of those KPIs and track them over a period of time. And then what I've seen is that there are so many disclosures, and you can pick a wide range of KPIs. Well, some still remain as they were, just that your income statement now is slightly different. You have your insurance section, you have your reinsurance section, you have your finance section, and you also have the investment section. So that's separated, and all that totaling to your profit. The return on equity remains the same on how you calculate it. So those ones will still remain the same. But again, like I mentioned earlier, the terminologies will change. It's not business as usual the way we previously did them. Thank you.
Thank you very much, Jane. I guess you've done justice to, there's a question in the Q&A box, around KPIs. Your answer was quite exhaustive, and I'm sure the participant who asked that question is satisfied. Now, Yemisi, over to you. Let's not look at from a functional point of view. IFRS 17 implementation has, created an opportunity to bring the accountants and the actuaries together to work together. How, from your experience, how has that played out?
Well, thank you for that excellent question. I think for us at Leadway, we realized very quickly during the implementation phase that we needed to work hand in hand very closely with the actuaries for us to even get our head around all these new concepts and new ways of working. So we took a conscious decision to sort of work collaboratively with the actuaries. And for us, one of the things that we have been able to put in place is to ensure that by working together with the actuary, we have a deeper insight into the output from the actuarial models. And it allows us to ask the right questions. So for example, when you're looking at some of the technical complex calculations around the risk adjustment, you're able to actually ask the right questions. If you see that the movement, for example, looks odd, we ask the question. We don't wait till the end of the process. And when they throw you, or when you have your output numbers, to begin to ask questions. So it was a joint collaborative effort in terms of improving the accuracy as well of the financial estimates, financial numbers that we present to the business. Working with the actuaries meant that before we even get to the end stage of producing the numbers, we've had an opportunity to review together with the actuaries. So within Leadway, we have a financial reporting and actuarial council. So we review the numbers, at the end of the process, we look at it together. And an interesting thing is that the business now is also interested, because they also want to understand what the numbers mean. Because IFRS 17 is quite technical and complex, we're getting more engagement from the business, because when they look at the numbers and we say, okay, the reason why these numbers look different from what you're used to is because we now have to discount the cash flow. We have to do this, we have to do that. So you try and explain that to the business. The only reason why we can do that is because we are now working collaboratively with the actuaries, and we're able to get a better understanding and insight. The other point I think I need to make is around better risk management for the business. The information that we're able to produce from the numbers really gives us an opportunity to advise the business So, for example, you have a line of business that you can see that the onerous contracts are actually rising. You can start having that conversation around, let's look at the underwriting practices again. Let's look at our risk management practices. And the business itself is now taking more initiatives to reduce onerous contracts within the within the reporting. In terms of, I mean, the other thing I think is really important to mention here is around the governance and controls. You would imagine that in the old world, the only time we would speak to the actuary would be when we want to get the valuation or the reserves. But I think part of what IFRS 17 has enabled by making us work closely together with the actuaries is there's a lot more control and governance around the production of the numbers right from the data point. So with the data input that is being used by the actuaries to do your future cash flows and things like that, there's a gate, and you kind of can put controls around making sure that that input data is correct even before it gets into the actuarial system. When the actuary, which is going to churn out your primary statements. So there's a whole lot of more vigilance and control around the preparation of the numbers. So I think, to summarize, it's really important to ensure that there are no silos within the entire process. I think what we have succeeded in doing is to make actuaries accountants and accountants actuaries now. So it's been a very enriching experience for us. And I think that even from the operational efficiency perspective, it makes sense for both the actuaries and the finance teams to work together closely. Where it's more like a joint, a large team now, the way we approach it at Quibi. Thank you.
All right, thank you very much, Yemisi. Just following from what you have said, I think Q can then, provide perspective from the actuarial side. So Q, what would you say actuaries now need to do in view of the fact that there is now increased collaboration with the finance executives? What do you think actuaries need to do for that to add value? You're muted. Okay, you're muted.
Apologies for that. I don't know why that keeps happening. Right. So what actuaries need to do is own the numbers that are produced by accountants, seeing as we produce these numbers together. We work together, as Yemisi has said, the actuarial department and the accounting department are like one department. So by the time that we're presenting these numbers, we own them, all of us. Now, the role of actuaries is to break down these numbers to the board and management and interpret them in the context of the business. She said something very important. Onerous losses, why are they increasing? What needs to be done? So then, which brings me to the next point of what we need to do in adding value. You see, we need to move away from the budgeting from a ratio-driven kind of budgeting. So when we're looking at a 5-year strategy, we're looking at next year's budgeting. We cannot have numbers that are just, where initially we would say, maybe increase in reserves should be 16% of the GWP. That's for life insurance. We need to move away from that. We need to bring in everyone together as actuaries and have budgets that are actuarially driven, like they're driven from actuarial models, projections of claims, projections of what expenses are supposed to be. We need to have IFRS 17 budgets built from actuarial models, but incorporating all business information, information from the sales departments, information from the financial controller who controls expenses, so that when they bring all this information together, then we can sit down and say, what is the impact of increasing GWP in, say, in the annuity product? What are the various outcomes from different business mixes? Basically drive this strategy using scenario testing. Let's not be, what's the word? I do not want to use the word lazy actuaries, but I want to use the word excited actuaries to drive business strategy in insurance companies. Let us run these numbers, show the impact of, probably changing the reinsurance strategy on the non-life side. Let us not just base our budgets or our strategy on the old simplistic methods. Let us do the real work and have all these things projected from sound actuarial basis. And then now going forward, you can even be able to track your budget. You already know this was your IFRS 17 profit. What happened? How is it that you're not achieving this profit? Is it that you didn't sell what you said you're going to sell in terms of business mix? It adds a lot more value into the overall bottom line of the company. Thank you.
Yeah. So thanks, Q. I think you mentioned some very fundamental things, especially around how the actuarial work can actually improve the level of budgeting. And also just listening to Yemisi, and someone just made that comment as well in terms of how it resonated with him, where this whole program of IFRS 17 has made actuaries accountants and made accountants actuaries. So it's really quite interesting. So I think overall it's really around the amount of value that the business benefits from that collaboration. So I'll just move over. We're not doing so well on time, so I'm just going to crave the indulgence of all participants that please be patient. It's a very insightful program. We certainly will exceed our time, but hopefully we will not take much of your time. So my next question will go to Kehinde. And Kehinde, really, I just want you to unpack what are the key business and operational benefits of IFRS 17. It has come to stay, and we're looking at what the future holds for finance and actuarial business. What do you think are those key business and operational benefits? Quickly.
Yes, thank you again. We've been saying IFRS 17 is complex and then it's costly, it's very expensive to implement. So you have asked a very good question. So what is the benefit of all those difficulties we are passing through? Are we just stretching ourselves? Are we just stressing ourselves for nothing, or are there a real good thing coming out of IFRS 17? So that is the question that will be on the mind of every business owner, of shareholder. That why all this wahala, if I can use that Nigeria local terminology. So there are some benefits. In fact, there are some quick win that we have seen so far, even in this last 1 year. And one of them is that there is transparency. Let me say there is more transparency. It's not that insurance account is not transparent before, but there is more transparency now, in the sense that you can easily compare insurance account with even account of non-insurance business. So every business we know measure revenue. That's the starting point. But before now, we don't measure revenue. We start with gross written premium. And you see many people asking, what are you people even calling this gross premium? So there is nothing like gross premium again now. We call it revenue, the same language that every business uses across the world. So that's an improvement there. And then it enhanced the credibility of that account. Also, it helped investor to build more confidence in our account now. So some things that they don't understand is clearer now. You just simply see insurance revenue, you simply see insurance expenses, which is what people are familiar with. Income, expenses, and so on, so that we don't have all this increase in outstanding claim, changes in unearned premium. That doesn't really make sense to many people and some investors. So it's very easy to understand the financial statement now. So, and I believe in this new capital era that we are hoping will be announced very soon, because the act is in the National Assembly. we are hoping that more investors will be attracted to the industry as a result of this new transparency and the increase in the credibility. Also, just like Yemisi have said, that accountants have become actuary and vice versa. So it's an opportunity for us to enhance our skill. We are reinventing ourselves. That is the truth, because we are learning new things, things that some of us have forgotten, like all this discounting, calculating present value. We did some of those things way back in management accounts, in the early 2000s. That's when we touched some of those things, but we are now bringing them back. We are learning them afresh. We are learning new things. We are learning how to do things again. Also, another important thing is that the performance measurement metrics is also changing in the industry. So we are not focusing so much on gross written premium again. Because if you look at some of the 2023 results we released so far, so you see a company that generated maybe gross written premium of 50 billion, but the revenue reported could be 25, or the revenue could be less than 25. So it is now more realistic, and that performance measurement is changing. It's less focusing on gross written premium and focusing on what have you earned, which is true value. Based on what our first speaker said, I think I can remember, Nagari, based on what Nagari said, that we are now focusing on true value. We are not focusing on just numbers that at the end of the day, when you unpack those numbers, they don't really carry much value in them.
Yeah.
But what we are focusing on now, carry much value. So those are some quick wins that we've gotten, and we have also realized that we don't have choice than to invest in technology. That is also coming to stare us in the face. And we have also seen that we must challenge ourselves and learn this IFRS 17. Yeah, thank you.
Thanks, Kendi. So in the interest of time, I'll quickly just move to Mrs. Charles, our regulator, to regulate everything. So, Mrs. Charles, what are those expectations, beyond IFRS 17 from NICOM? I'm not preempting anything. I think Kende mentioned, regulatory capital requirements that are driven by the codes that is being expected. But generally, what are those expectations beyond IFRS 17 compliance?
Well, thank you very much. From the regulatory perspective, one of our expectations is that the insurance entity will enhance their data management practices. We expect more granular and transparent financial disclosure. We're expecting them to strengthen their internal control and governance framework, which is very, very important for us to be able to address their processes and then all the control gaps and how to mitigate against risk and ensure compliance. Beyond just minimum compliance, we're encouraged to adopt sustainable practices. There should be more integration between the actuarial function and the finance function, especially in terms of the risk adjustments and discounting mechanism being used. So we're expecting them to align their cost recognition with the associated level of risk that they are carrying. We expect more collaboration, and then we expect that they will foster congruence between their cash flow, the risk margin, and the corresponding expense profiling. So in the nutshell, we're expecting improved transparency of insurance performance, and we believe that potential investors' confidence will increase as a result of this IFRS 17 that has been introduced. And from NICOM, we try our best to ensure that we encourage open dialogue between the insurer, the stakeholders, and all the stakeholders that is involved. We create an enabling environment where we'll be able to regulate. We are no longer being prescriptive, but we're going to take into consideration the customers and how to manage them. So we're going to be more open, and then we're going to be more creating an enabler environment that will enhance and increase the productivity of the insurance performance business in Nigeria. So in terms of the capital that they are looking at, I believe that is in a nutshell that will come as time goes on.
Yeah. All right.
Thank you very much. We expect them to automate and remind their processes. Thank you very much.
All right, thank you very much. I'm mindful of the fact that we have, some of our colleagues within the West African space in the Sun City. They are also listening to this. I know that what Mrs. Charles has said, in terms of expectations, it cuts across all regulators within the region. Amit, I'll come back to you. Based on your experience as a consultant within this space, you've been one of those who, developed quite a number of the tools that are being used in the industry today. So what solutions do we have, maybe as Deloitte, to help navigate, business as usual transformation? Because now we're moving to the segment where we're now talking about the future. What do we now need to do going forward?
Perfect, thanks. So for me, before we even start talking about solutions, one of the first things we would do is come in and assess the pain points and the concerns that have come out of the first reporting and audit cycle. And I'm sure that many would describe setbacks around their financial reporting tools and their data quality as the key issues, as we've heard. And those are the areas that we would need to look at resolving immediately, with priorities therefore shifting to the enhancement of your business planning tools, your budgeting, and the streamlining of your actuarial modeling tools. So these are the areas that Deloitte, we focused on, with the realization that budgets are limited and that further enhancements, the budget for those are actually very constrained. So examples of tools that we've looked at is things such as an Excel to digital twin, to enhance the capabilities of Excel by looking at the automation, controls, and auditability of these spreadsheets, especially where Excel is still seen as the main backbone of a lot of the solutions. As we said, a lot of people did invest in systems, but there are still quite a bit of manual spreadsheets, etc., that are used. So we've looked at ways in which we can actually automate these. We've also looked at tools for budgeting and forecasting and planning that then takes a bit of a shortcut and uses the output from the GMM reporting and overlays a new business input over that. Performance management, as we've heard, some of the KPIs is also a key component. And we've looked at developing a KPI repository that looks at currently used KPIs and either adds or modifies them as necessary. So as mentioned, looking at the numerator, the denominator, and seeing where we can actually change some of those elements. And then as mentioned, there was quite a lot of emphasis around training in the prior discussions. And that is often an overlooked element, especially now as we move forward. People are thinking the training element is over. But what we're finding is that the training was ad hoc. It was rushed. A lot of the teams actually were just trying to get over the line and didn't have full capability in terms of understanding the nuances of the standard and some of the requirements. And I think that's where our training capability is still very relevant, especially as you mentioned in my bio, the development of the e-learning solution that we actually have, where people are able to do the learning at their own time, at their own pace. New joiners, people who have done it before, can redo the learning. And I think what's really important about that is that it's both theoretical and practical. So it looks at a numerical example, takes the journal entries, and takes you through some of the T accounts as well, so that you're able to see how the accounting works, which I think is often overlooked in training. They just look at the requirements of the standard. There's numerous other tools available globally as well, but those are some of the key ones we've looked at from an Africa perspective, especially trying to take into account the cost constraints that many of the insurers on the continent actually have.
Yeah, thanks, Amit. I think in the interest of time, I'm going to plead with the panelists to just just summarize your answers without actually losing the main points that we're trying to pass across. Jane, I'll come back to you. I know we've said a number of things around risk-based capital planning that is coming up, IFRS 17 and all that. What do you think insurance companies, insurance entities need to do to kind of power up their finance transformation journey for them to be able to stay competitive and bring that higher value to their customers?
Thanks, I think we've now totally moved from rule-based and all these prescriptions we get to more of principle-based. And what I see coming up now, a major thing is the enterprise risk management. So each entity now will really have to assess its own risks and manage, depending on what business and what lines of business you are writing. And in addition to that, at a more granular level. So I see a lot of asset liability management. I also see a lot on data. We now need more data. Quality is key, the control and management, and especially from the finance perspective, what we've tried to do is also relook at our general ledger, because there's a lot more information required for this, whether it's the IFRS 17, it's risk-based capital that you are looking at, the general ledger, which is the primary financial statements and all the disclosure that we get. Our chart of accounts at the group and business unit levels is going to be very critical and key. And I think we are really going to consider solutions for supporting parallel reporting, because some of these requirements could be slightly different. So it's encouraged that you try and do parallel reporting depending on the need you have for the day. Thank you.
Thank you so much, Jane, and thanks for summarizing. Next question will go to Yemisi. So Yemisi, I mean, reading your bio, we could see that you are an expert in finance transformation. Now, finance transformation within context of a post IFRS 17 implementation era. What's your take in terms of the main driver for initiating all of these finance transformation initiatives post IFRS 17?
I think a lot has been said. Thank you very much. A lot has been said really around IFRS 17, and it's really a major driver for finance transformation. But over and above that, I think that for a business, any insurance business now, to be able to scale and be able to respond very quickly to changes in the environment, as well as changes from the regulator, you need to actually optimize your processes, optimize your system, automate, the key processes. Even something as mundane as producing your stats account, even when you finally have the numbers, it needs to be automated, because with IFRS 17, the disclosure requirements are huge. And I think that, just looking at the different dimensions is a big driver for transforming the finance process. Without taking anything away from what has also been said, I'll go back to the subject of data. Because we concentrated on data, just looking at it from the fact that there is data granularity and you need that input to go into your financial systems. But it goes beyond that. I think going forward, looking forward into the future, I see a lot of enterprise data infrastructure being built, because data is now going to be the new money that drives performance across the business, not just for reporting. Because that data is what the business is going to use to make decisions that are actually going to enable them to increase their performance. So in a nutshell, I think agility and scalability is really important. Being able to achieve faster financial close by automating the process end to end, improving the data quality and transparency of that data also is really critical. Thank you.
Yeah, thank you. So data, I think that's one lesson we need to take out of here. It's not just enough for us to pay lip service to this whole data transformation thing. I think it's important that insurance companies need to really sit down and look at data. It covers quite a whole lot of things beyond IFRS 17. And thanks, Yemisi, for reiterating that. And hopefully that'll be one of the things that people will be taking home from this webinar. And I would come to Q, similar question like I asked Jane Q, but from an actual transformation perspective, do you have some comments around what you need to do or what insurance companies need to do in terms of transforming the actual function to create value? I know you've mentioned a couple of things around in your first question when you talked about what actuaries can do in terms of balance sheet transformation. But from a general functional perspective across, the actuarial function, what do you need to do, should insurance companies do in terms of the actuarial transformation journey?
Right. Thank you. I would say that the other thing that we could add is the points we talked about earlier, value-based, where we're looking at the profits of the company as of today, and then the profits of the company based on what is locked in. It's important that we're able to probably always quantify these measures, quantify the return on capital according to the profits that we already have, and the return on capital, looking at profits that are yet to come in terms of the CSM adjusted for risk or the traditional embedded value. Those are some of the things that as actuaries we can continue to do. And of course, being available to explain all the numbers in the context of the business. It's important. Knowledge is not, as an actuary, when you know something, but you cannot communicate it to the business, then it is of no value to the business. It's important that we're always able to communicate to the business what's happening with the accounts and the numbers. Right. Yeah. Thank you.
Thanks, Q. And Kende, I'm just going to ask this question. I need a very straight answer, maybe in few words, okay? How can we manage a talent war? Because we've all agreed that talent is a major problem. What can we do? Just what's your answer to that?
Yes, thank you again. No doubt there is that scarcity of skill in IFRS 17, and how many of us CFO are even beat his chest today that he can prepare the IFRS 17 financial statement from start to end without the support of any consultant. So it's clearly on the table, but we have to face it. We have to take our destiny in our hands. It's already here. We cannot run away from it. So for me, the way I believe we can manage it is to look inward and train and retrain and continually train our people. So even if we say we want to start poaching staff, and by the way, I suspect you might have been witnessing poaching of your staff after the 2023 AFS. So even if we're going to poach staff from the Big Four, how many can we poach across the industry? So we must look inward. We must train our people. We must train ourselves, starting from the CFO, because the truth is, this IFRS 17 load is more on the shoulder of the CFO than any professionals in-house. Yes, the actuary are also there with us on the journey, but we carry much more of the load, and most of my colleagues can agree that with me. So we must not shy away from it. And it's something that we can learn. Yes, it's complex, it's difficult. The only thing that you cannot learn in life is what you don't have capacity to learn or the capacity to understand. So if we have capacity to understand it and we have capacity to learn it, then let's learn it. Let's be intentional about developing our competency in it. And not only the CFO, we must cascade it down. We must build a team of talent in IFRS 17 so that people that are coming behind us, they will not feel blank when they get to the office. They have full of knowledge that they can tap from. I think that is the best way I would say we can approach it. And lastly, of course, regulator must continue to support us.
kudos to NICOM. I will be very honest with you. NICOM have supported us very well. They are leading in the front when it comes to implementation of this IFRS 17. Things like the insurance industry financial reporting working group. That group really helped a lot. And I think I would suggest NICOM should not disband that group. It can metamorphose to something else. But that is one very good initiative of NICOM. And I think they should not disband it. They should look for a way to continue to use that group to still drive knowledge transfer in IFRS 17. Thank you.
All right. Thank you, Kende. And you've mentioned, support from the regulator. Maybe that takes me to Mrs. Charles on what the regulator can do. So I'm going to ask two questions in one so that we can, speed up. We're coming towards the end of the webinar. As a regulator, what do you think needs to be done, or what's your advice on, kind of shortening the reporting? Last time it took more than a year to report. This time around, we want it to be shortened. And in addition to that, what do you think are your key takeaways that you want to share from this webinar?
Okay, thank you very much.
Yeah.
In terms of the shortening the reporting, is it the approval process that you're talking about, or what do you, that question you need to really define it?
Yeah, so the reporting period covers from, preparing the financial statement up to the point where it is fully approved. And there are stakeholders from both sides, both from the regulator and also from the practitioners themselves. What's your advice in terms of how we can do things better next time around so that that whole period is shortened? And in addition to that, what are your key takeaways, few takeaways from this webinar that you want to share with us?
Thank you very much. Well, in terms of the timeline, we are going back to the normal process. The normal, this thing is every account must be turned in on or before June of every year. But before then, we will provide help desk, and then we are still going to have an engagement with the industry to discuss observed lapses, areas that needs to be improved upon. And I believe with that, they'll be able to see what they need to do to ensure that their accounts comply and they'll be able to submit their accounts on time. Apart from that, we offer clear, detailed guidelines where necessary to assist in the in continuous delivery of their accounts to us. We pray that we believe that we need to organize, we need to engage more, organize more training, and then training session, workshops to build capacity. And we establish mechanisms to be able to monitor the financial performance of the industry. Above all, my takeaway is I just want to say that we should continue to maintain comprehensive documentation in terms of data quality optimization is very important. Operations optimization is key. Our system integration is very important as well. And then we need to improve on our financial reporting, overall financial reporting. I believe with what we have seen so far and with the lesson lines and the pitfall that has been identified, the overall financial reporting will be better and it will be improved upon. So yeah. to us as NICOM, we continue to create enabling environments and we ensure that we organize all the necessary sessions, training sessions, capacity building, knowledge sharing, and then we maintain the committee that has been established. And if there's need for us to improve or to even come up with another committee that will help, I believe NICOM is all out to do that. And we believe that at the end, it will improve the overall business performance of the insurance entity. Thank you.
Absolutely, Mrs. Charles. And real kudos to NICOM for the enormous support in terms of timelines, everything, during the IFRS 17 era. Now, before we take the final words from all of the panelists, I have a question here for Q from Naliaka Wafula. says a question for Q. How do you think IFRS 17 affects the regulatory capital requirements in the region? What updates should regulators do from an actuarial perspective to ensure a seamless transition in the requirements? I don't know if you got the question.
Yes, sure. Thank you, Naliaka. So regulators are already doing that. We can see that I believe you're from Kenya, from your name. So we already have the risk-based capital in Kenya, and we can leverage this for purposes of computing the risk adjustment. In Nigeria, we are now introducing the risk-based capital, which again, we can use for IFRS 17 and also use now for our pricing, incorporate the cost of capital into the pricing of products. But maybe what is peculiar to your country, or rather to Kenya, is that there's usually a restriction of surplus. Now, IFRS 17 is already restricting surplus in the form of CSM. So for life insurance businesses in Kenya, you cannot transfer all the surplus. After you make profits from the surplus declared, you must restrict 70% of that. So maybe you can look at probably saying that there's already surplus restriction in the form of CSM, and that has already been taken care of by IFRS 17. So we don't need to double restrict surplus. Thank you.
Yeah, thank you very much, Q. And so I'm just going to give each panelist 20 to 30 seconds to just reflect reflect on what has been discussed so far, and maybe in some few words, what are the key takeaways that you think people need to action the moment they log off from this webinar. So I'll start with you, Jane.
Thank you, Wei. My key takeaway is data. Data. I think data is now the new gold. And what we want to see is more data expertise. We've talked about the learning curve, and I think that's an area we really need to pay attention to. There are many tools now from AI that we can use. For accountants, we're really working closely with the actuaries who are quite experts in data management. Our systems and processes, we really need to enhance automation, integration with other systems, especially the financial reporting systems that we use, and also systems optimization. This, I think, will also help in reducing the reporting timelines, which currently are quite long. And lastly, I think for me, it's just learning, collaboration, teamwork. Year one, we had a lot of simplification. We had a lot of this is market consistent. I think now going forward, our modeling, our policy choices has to be redefined, improved, and the learning curve continues. Thank you.
All right, thank you so much. Yemisi, quickly.
Thank you. I'm not repeating everything Jane has said, so let me just add two things to that. I think going forward, we should also think about capital allocation. It's really important to understand how you're allocating to the different lines of business, and IFRS 17 makes that easier now because there's a lot more transparency. I think the second point to also make is about start thinking from CFOs on the call, start thinking about new metrics that you are going to measure in terms of driving performance of the business and managing your stakeholders, explaining what these metrics means to them and how they can actually interpret those metrics. One more point I said to find out also is around the workforce. It's really important more than ever to actually think about what else you need to do to empower your people. This is it's an ongoing thing, so there is going to be room for improvement. Those, I think, are the three things I'd like to mention. Thank you very much.
All right, thank you very much. Kende? Kende,
yes.
Okay.
Yes, I'm here. I'm
quickly.
here. Yeah.
Quickly.
Okay. So I think one thing that is very important is company must invest in technology. That is very important. Our business owners, business leaders must be committed and give their buy-in into investment in technology. So we are struggling to import from one application to another, take from here, put in Excel, take it, put in Excel, join them together. We need to go away from that processes if we want to really get IFRS 17 right. Like Yemisi and Jane have mentioned, data. You are not going to use Excel to drive that data. That is the truth. You need technological tool to drive the data that we are talking. So companies must invest in technology, advanced technology, modern day technology. And lastly, training.
Thank you. Thank you very much, Katie. I think you've made your point. Q, before I come to Amit, you're muted. So yeah, I was saying, any last maybe any takeaways that you want people to action?
Yes, sure. Let us learn and let us share knowledge. That's all.
Yeah. Thank you very much, Q. Amit?
Perfect, thanks. So for me, it is the fact that now is the time to assess the maturity of your finance process for your transformation journey. Most people are spending time just analyzing and looking at producing reports, but we need to start making sure that you're able to interact and communicate with business. Don't lose momentum. Start assessing those opportunities for enhancement and optimization. And it doesn't have to break the budget, I think, is the key point.
That is the key point. Thank you very much, Amit. And thank you very much, panelists. It was a very, very engaging session. At this point, I'm going to invite Oduare Uwadia, who is our assurance leader, Deloitte assurance leader for West Africa, to just take us to take the vote of thanks. I think we've exhausted all the questions that are in the Q&A box. Oduare, over to you.
Thank you very much, Uyi. This has been a wonderful session. I've been taking notes upon notes. You can see all that I've been writing. It's been a wonderful one. Thank you, Frank and Francesco, for your time. I know you are 8 hours ahead of us. You took time to stay back to our knowledge sharing initiative. It's been wonderful. I quite appreciate your collegiate approach to it, and also the fact that with Deloitte, we've been part of the process all along globally, helping to shape the conceptualization, the development, exposition, finalization, and also supporting in the process of implementation of these standards. And to our wonderful panelists, thank you very much. I've taken lots of knowledge from you. Thank you, Jane. It's been a wonderful presentation you made at the introductory stage. Yemisi, I love your actuary becoming accountant becoming actuary, and I'm happy that Q keyed into that, and our own concept of excited actuary, now having situation where actuaries are now part of the process. Before, we used to keep them at the background. We only just ask for figures from them, and that's how we've been related. But now we are more collaborative with our actuary. Kehinde, you took us back to the legacy knowledge models of NPVs, CAPIM, all those sensitivity statistical models that we learned in theory. You are right to say we've brought them back. Thank you, Oluwatoyin, from regulatory perspective. It's been a great one sharing knowledge. And to Amit, also, thank you. You've been so wonderful supporting even within Deloitte and also actually outside of Deloitte. Thank you, everyone. Kehinde, thank you also for your collaboration and with the other panelists to supporting this wonderful initiative. And to our participants, thank you. We wouldn't have had this program if you never signify your intention to participate. We wouldn't have been speaking to the air. You are there, and thank you for all your questions. All your questions are well taken, And the ones that we have responded to is being recorded, and the ones we are not able to respond to will be responded to in due course. So thank you, everyone. And we and the team, it's been wonderful putting this package together. I want to appreciate you, Michael, and every other participant in this program. Thank you very much. And I think I would like to bring and to our participants also from Sun City, we appreciate your participation. We want to say thank you also to being part of this program. So thank you. I would like to bring the program to a close on behalf of our leadership, Deloitte West Africa, and also Deloitte Africa. Thank you, everyone.
Thank you. Bye.
Thank you. Yeah, bye.
Thank you. Bye.
Bye.
Thank you, everyone. Bye.
Thank you. Thank you.
Thank you. Bye-bye.